Okay, this is chapter 6, financial statement analysis of this course. The course is again accounting for managers. So far from the first three chapters, sorry, three chapters, yes, first three chapters, we learn about the financial reporting. What do we need financial reporting? Financial reporting, if you still remember, that's needed for the external users. External users, the one who are interested how the company performed and how the company doing. They're interested in financial statements. So for their purposes, for the purpose of the external users, which can be creditors and investors, we're gonna prepare the financial statements. There are a set of financial statements. The first thing that those users they want to see is the ability of the company to generate income. So for that reason, we're going to show them first the income statement. Once they see the income statement, investor wants to see how much of the income statement from the income which is earned from the company actually stays as owner's equity. So they can see what's the amount of dividend paid, is the company paid dividends or don't pay dividends, and after that they want to see balance sheet so they can see uh, where is the assets of the company and how those assets were acquired through the debt or through investment. They want to see also other things, which are other things we're going to find out today. The next set of knowledge that you get from the last week was about long-term assets, that specific category of the asset sides or capital assets, also called capital assets because they're used for the long term, more than operating cycle of the company of 12 months uh, to generate revenue. And through that period of time, we slowly going to transfer the cost of the assets into the expenses as a depreciation to match the revenue that those assets generate. So today we're going to focus on the financial statement analysis. In order to do that analysis, again, the financial statement analysis is mostly done for the purpose of the creditors and investors. So the one who's going to lend the company money and the one who's going to invest money in the company, they're based on the 5 financial statements: statement of financial positions, statement of income, statement of cash flow, statement of changes of equity, and notes to financial statements. Not necessarily in that order, but that's the order, and that's those statements are presented as a set of the financial statements. Through those statements, those two users of the financial statements going to try to assess financial health of the company. Is this company able to generate cash? And is this company actually operates efficiently? So if we invest in this company, are they going to have ability to generate the desired cash that we want? Now, the statement analysis is to process the financial statement analysis. We need to follow some steps. First step is to determine the purpose and the context of the analysis. It will be very hard to do the analysis if you don't know for what purpose you're doing that analysis. Is it doing it for the purpose of lending money? Is it doing it for the purpose of investing? What exactly? Or you just do the analysis just out of curiosity? Then we need to start to collect the information. Once we need the purpose, we need to start to collect the information. We have to use the collect the information which is needed for the analysis that we already determined that we're gonna do. Then we're gonna prepare common size analysis, and we're gonna calculate some ratios. So we're gonna see what's the common size analysis. And then we're gonna interpret and analyze whatever findings we find from those analyses into the metrics, and then we're gonna come up with a conclusion and recommendation what we're gonna do with the company. Are we actually gonna give them money as a credit, or are we gonna invest? Now, each analysis will be there different analysis which is with the decision which are made. So basically, if we're doing the investment analysis, we have to do analysis on the is it appropriate to buy or to invest decisions. For the commercial lending, that will be is this company uh, credit worth or can comply with the covenants, covenants restriction that we can put in order to protect our interests in the company. For the credit department, we want to see if the customer actually pay within the credit terms. For the company which is looking for acquisition, we're gonna take a look at what's the book value of the company. Remember from last time we're talking about the goodwill and how goodwill is generated, but the goodwill is when one company acquires another company. And if we're a pension fund, obviously we're gonna look for the steady income over a long period of time. So we're gonna look for the investment opportunities for the long period of time, usually more than 20 or 50 years. So in order to do those analysis, we have to understand the business. How we gonna get that knowledge well from everywhere. One of the purpose of this course is you to get some ideas of operating activities which happen in the every business. So one of the operating activities that happen in the business is purchasing a capital assets, which are going to help us to generate revenue and slowly transferring the cost of those assets over the useful life of the assets as expense to match the benefits that we're getting from those assets. Other benefits to understand the business will be to underlying economics and risk in the industry. So we have to be very well familiar with the industry, what kind of industry this company work, what's the country that they are currently operating in, what's this, anything related to the business environment and the nature of the business in that specific country for that specific business that we acquire. Then we're going to see the overall strategy, which is followed by the customer in the company or the company that we're trying to analyze. Is it they providing everything on the low cost or they're looking for something to differentiate themselves from every other competitors on the market? What exactly is the strategy? We're going to see in the next part of the course, we talk about more about the strategies. So we can broaden your analytical skills for understanding company business. And we're going to look at some key successful factors, which is which is going to help us to understand how healthy is the company, and is it worth it to invest in the company or lend the money. So the fundings, very interesting things we may find in the annual report, which every company now have to submit it. That's called annual report for management discussion and analysis. And that's exactly how it's called, management discussion and analysis. And that's becoming part of the 5 of the financial reports which a company has to prepare every year. So that's become the 6th report. So the 5th reports are statement of financial positions, statement of income statement, statement of owner's equity, cash flow statement, notes to financial statements, and now we have this management discussion analysis report, which becoming part of the annual package. We're going to review any other additional information about the company. We're going to read the financial statements. Also, we're going to read the auditor report. What kind of audit opinion the auditor express for when they're reviewing the financial statement? Is it modified? Is it unmodified? Qualified? What exactly is? And obviously, we're going to pay close attention to the notes of financial statement and management discussion analysis. The 2 type of analysis, prospective analysis, the one that's looking forward, from this point of view, we're trying to look if we lend the money to this company, is this company have ability to generate cash so we can get our interest back and our principal over the period of time. Now, challenge for this method is future is very hard to predict unless you're a fortune teller or seeing fortune teller. The other one is the retrospective analysis or historical analysis. Through that analysis, what we're going to do, we're going to try to identify through the past years of the company any trends, any patterns, anything that happened with the company, and then link it with the current available information and try to predict what's going to happen. That's another type of analysis. We're going to look back on the historical data of the company and try to find those analysis and to try to find what may possibly happen with the company. Obviously, if something fundamental happened with the industry or with the company, it will be very hard to apply this historical analysis since everything is going to change after the certain point of time. Trend analysis is another thing, and again, trend analysis based on the historical data. That for the trend analysis, in order to talk about trends, remember this, we need to have at least 3 years. At least 3 years. If we have only 2 years, we can talk about differences between 1 year and another year. But if you want to talk about trend, we need at least 3 years. So be careful first on the quiz. If you have 2 years, we can talk about only which you're going to have 2 years. We can talk only about the differences. Same thing apply to the assignment, which you have to do the memo that you have to prepare in class. Again, if you have only 2 years of the company, which you're going to have the company, then you can talk only and only about the difference between 1 year and the other year, not trends. For trends, you have to have at least 3 years. Cross-section analysis is that we can compare 2 or more companies, but in that case, those companies have to have a common size financial statements. Otherwise, it will be very, very, very hard for you to compare 2 companies if they're not using common size financial statements. We're going to come to this and I'm going to explain what the common size financial statement is. Which data we're going to use? We can use a raw data, which directly from the financial statements. We can then we're going to start doing this trend analysis, and we need to require at least 2 years of the financial data in order to compare 1 year to another year, or for our comparative purposes, so we need at least 2 years. So that will be information or example for the raw data. As you can see here, we have now information about 1, 2, 3, 4, 5 years of this company. So if we prepare something analysis, we can talk about trend in this situation. Yeah, again, if you have only 2 years, then we can talk about differences. So now common size data. What's the common size data? For the common size data, before I go to the common size, I want to show you something, and I want to practically use this one. So I want you to come up with the idea with the common size. Again, I'm going to use Excel spreadsheet to help me to explain the common size financial statements. Briefly and very quickly, I'm going to draw you 2 company income statement. Let me share my screen again. Okay, share. And now I should use, you can see my Excel spreadsheet. So let's do some magic here on this Excel spreadsheet in terms of, let's prepare 2 companies. Let's get company 1, number 1, and let's get company number 2. Pure improvisation here. There's nothing from the textbook. Everything is improvised directly in the real time. Let's prepare the income statement for both companies. Now, let's pretend both companies going to have sales. Let's make it a little bit bigger. Let's make it to 18. Both companies going to have sales. Both companies going to have cost of goods sold. And both companies going to have gross margin. Both companies going to have operating expenses. And both companies going to have operating income. Okay, gonna copy this, gonna flip it right here. So now what both companies gonna have, they're gonna have a different information. Sales in the first company, let's say sales in the first company is $15 billion. That will be 1, 2, 3. 15 billion, 1, 2, 3, and 1, 2, 3, and 1, 2, 3. That's $15 billion, first company. Then the first company is going to have $12 billion cost of goods. Now let's make it more. Let's make it less. $10 billion. 1, 2, 3, 1, 2, 3 million, 1, 2, 3 billion. $10 billion cost of goods sold. Then the gross margin will be this one minus this one. And then they're going to have operating expenses of $3 billion. 1, 2, 3, 1, 2, 3, 1, 2, 3. And obviously the operating income in this case will be $2 billion. Next one is gonna be way more simple. Let's copy this one. The next company will be very simple. That's gonna have $100,000 sales. Cost of goods sold will be 20,000. And then gonna have 10,000 operating expenses. $70,000. That's the operating income. Now the question is, everything is dollars. This one is dollars, this one is dollars, this one is dollars, and this one is dollars. Now the question is, if you have to invest money, in which company you're going to invest your money? In company number 1 or in company number 2? Don't say it's company number 1. Any other suggestion?
Company 2.
Company 1, company, now we have company 2 coming in the picture. Now let's think about logically here. Can I compare those two companies? Can I compare them based on the sales? Hmm? What do you think? Can I compare those two companies based on sales? Are they making the same sales? No. Obviously, we can compare by sales. So, but what do we know? We know that the sales are the total amount, as you can see, the total sales is our starting point, and after the sales, everything going down. So sales as a percentage, if I have to express sales as a percentage, it will be sales divided by sales. This one divided by exactly the same amount, it's going to be 1. As a percentage, it's going to be 100%. Make sense? And in this company, again, the sales will be, as a percentage, will be sales divided by sales. As a percentage, It's gonna be 100%. Now I have something in common. What is that in common? For both companies, sales are 100%. Then what I have to figure out, how much is each of those elements as a percentage of sales? Here, how much is the cost of goods sold as a percentage of sales? That will be cost of goods sold divided by sales. And as a percentage here, I have 67% cost of goods sold. Then the gross margin obviously will be 100 minus 66. Let's leave it without the decimals. Gonna be 100 minus the 67%. And then I'm gonna have operating expenses. Operating expenses as a percentage of sales, it's gonna be 20%. And then we're gonna have operating income as a percentage of sales, which in this case is 30%, which makes sense. Let's check the same percentages in the other company. In the other company, cost of goods sold in this company divided by sales is 20%. And gross margin in this company is gross margin divided by sales. And this company is 80%. In which company the gross margin is higher?
Two.
Number two, right? No questions about it. Number two company, the gross margin is higher. Let's see now the operating expenses as a percentage. In which company operating expenses are relatively low?
Two.
Two. Now the question is, which company generating the highest operating income as a percentage? Two. So what that means, what these percentages means, that means very simple. For every dollar of sales, if the company one generate $1 of sales, how much operating income they gonna get from that dollar of sales? Only 13%, correct? So for every dollar of sales, this company is gonna generate 13 cents. Make sense? How about the other company? In the other company, for every dollar of sales, if I sell $1, if my sales are $1, how much will be my operating income? How much is gonna stay for me? 70 cents. Can you see it? For every dollar of sales, you're actually generating 70 cents. Where do you want to invest your money? Which company is going to give you more cash? So how we come up with this idea? If we compare company of the dollar amount, we cannot compare those companies. Why? Because they have a different sizes. They have nothing in common. So what we have to do, we have to come up with the common financial statements, common analysis. Common analysis is when we convert everything into percentage. And once we convert everything as a percentage usually doesn't lie. So I'll show you something. If I do this, and what I'm gonna do is that's company one, let's put this two, and company one here. And if I hide this here, And if I hide only this column, and if you see only this information, now in which company you're going to invest?
Two.
Clearly in company two. So do you understand now that the dollar amount, it doesn't matter. Yes, when you open the dollar amount, suddenly you come, oh my God, look at this company. They're generating $2 billion. Yeah, but they're generating only 13%. For every dollar that you're getting, they give you only 13%. For every dollar this company they sells, you're getting 70 cents. So your cost here are only 30 cents. Your costs here are 87 cents. Make sense? That's your common statement financials analysis. Yes, there's a raised hand. Is there a question? So again, the common size financial statement that's involved converting dollar amount values into percentage on the specific base amount. As you can see in the both company, our sales was 100%. So the base is the same. And then we're expressing everything else out of the sales. Now for the income statement, we're going to express percentages of the total sales. The common size analysis can be also used for the statement of financial position and cash flow statement, but then we're going to use different basis for the comparison. For the income statement or statement financial statement of income, we always going to use revenue as our basis. So revenue always going to be 100%. We're going to start expressing everything as a percentage of the revenue. And as you can see, this for this particular company in 2019, their net earnings was 5.6. So for every dollar of sales, they're getting 5 cents, 5.5 cents, then drop down to 3, almost 4 cents, and then climb to 4.4 cents for every dollar sales. Now the ratio analysis, when we have this ratio analysis, then we can compare different companies. And that will be allowed to compare the different size of a company more easily, as we saw when one company is in the range of $1 billion, the other one is only on the thousands. The other type of analysis is the common category. We're going to come for the common ratio analysis, which will be depends on the different purposes. We're going to have liquidity ratios, which are related to ability of the company to meet the short-term and long-term debt. Activity ratio, which shows how the company operates. Solvency ratio, going to give us an idea of the ability how they're exposed to the debt from the outside. Profitability ratio is going to give us different ideas about how profitable the company, and the last one is the equity analysis ratio. So let's start with the liquidity ratio. On the liquidity ratio, again, it's going to show us how fast we can convert assets into cash. Since the cash is the most liquid assets, we already talked about this. The most liquid asset in the company is the cash. Everything else is takes time. There are two common liquidity ratio. One is called current ratio, the other one is quick ratio. Both shows ability of the company to pay the short-term debt. For the current ratio, we're going to get the current assets divided by the current liability. Now, today, I'm going to just talk about the ratios. I'm going to explain the ratios. Next time in class, we're going to think about the ratios, and we're going to take a little bit more practical approach in terms of which one is good for us, which one is not good for us, and what means when the current ratio is certain amount. So a current ratio, again, is the current assets divided by current liability. For the quick ratio, from the current assets that we have in the first formula, we're gonna eliminate inventory and the prepaid expenses. So what we're gonna stay? We're gonna stay only the cash, accounts receivable, some short-term investments, and that's all. Inventory, prepaid expenses, we're gonna eliminate it from the calculation. So let's see how this company performs. For this company, what we need is we need the balance sheet. I don't think we have a balance sheet for this company, unless this one from here we can see the balance sheet. Revenue, depreciation, total assets. Here we have some total assets, and that's all we have here. Interest-bearing debt, but this is only selective things from the balance sheet. So we cannot get anything here in order to be precise of our calculation. Nevertheless, let's go with the calculation and see what they're doing here. From the financial statements, they're getting the current assets and divided by the current liability. So in 2019, the current ratio was 162, then went to 163, and then in 2021 moved to 184. The question is this good for a company? Let's think about before we make a comment on this, is it good or bad? Let's think about for a second. Once we know that the current ratio is current assets divided by current liability, what means if the current ratio is equal to 1? What that's gonna, if we have current ratio 1, what that means to us? That simply means that the current assets are equal to current liability, correct? So anything above 1 is gonna show us that the current assets are more than the current liability. So further we are from 1, better for the company will be, correct? So when we check in this company and we see that this current ratio slowly start to climbing up, we can make a conclusion that this company actually going the right direction in terms of the current ratio. Why? Because as we can see is the current assets increase more than the current liability. Yes, the current liability also increasing, but not in the same way as the current assets. Let's see the quick ratio. The quick ratio, when we eliminate the inventory and prepaid expenses, suddenly the quick ratio drop down below. What that means is that this company currently don't have liquid assets, super liquid assets to cover the liability. Is that a problem for the company? Not necessarily, because in the current liability, not always you have something that you have to pay right away. So for that reason, this company, it might have time to convert the inventory into cash in order to meet the current liability needs. Activity ratio, and this is the activity, those are the ratios that I'm gonna test you on the quiz next time. Again, on the activity ratio, you'll be tested on the quiz next time in class. So that's not going to be this Thursday, it's going to be next Thursday. That will be as a date, that will be on May 7th. So that will give us idea how efficient the company managed the operation. We're going to have accounts receivable turnover, inventory turnover, and accounts payable turnover. Let's see first one, receivable turnover. In order to get the accounts receivable turnover, we have to get the sales, eliminate the cash sales, and leave only the sales on credit. Once we have the amount of the sales of credit on credit, we're gonna that will be our nominator. And as a denominator, we're gonna use the average accounts receivables. Now, how are we gonna get the average accounts receivables? That will be the beginning balance of the current year plus the ending balance of the current year divided by 2. If you have 2 years, then it will be the first year plus the second year divided by 2. For the first year, you're going to use only the amount for the first year. That's all. You're not going to divide it by 2. So once we get the accounts receivable turnover, that will be a number. It's going to show us how many times we have the credit sales in our accounts receivables. Once we get that number is going to become a denominator. Then the question is, what will be our nominator? Nominator to calculate the average collection period will be the number of the days that we have per year. Per year, you usually have 365 days, unless every 4 years we have 366. So let's think about it. What's a good number for us here? If our accounts receivable turnover is 1, what that means to us? That simply means that average correction period will be 365 divided by 1. Oh, it's going to be 365. That means we collecting accounts receivables or credit sales only once a year. On every 365 days, we collecting our accounts receivables. Is that good for a company? Well, that's probably not a good for the company. So where do we want this accounts receivable turnover to be? As high as possible. What's going to happen if accounts receivable turnover is 365? Then our average collection period will be 1. 365 divided by 365 will be 1. What that means? Every day we collecting accounts, our credit sales, which is great. So remember, in this case, we're chasing higher number. Higher number is going to be good for the company. If the accounts receivable turnover is low number, that means they're not collecting the credit sales too fast. So let's see how this company performs. In the first year, the accounts receivable turnover was 12.3. Second year, 11.4. Third year, 11. So as you can see, the number of the turnover start to getting low. Having in mind that we're looking for the highest number as possible, that's not a good indicator. How can we explain this? We can explain it with the day that we need to collect our credit sales. And in 2019, we're able to collect our credit sales in 29 days. In 2021, it takes us 4 days more to collect our credit sales, which is not good for the company. Next thing is the inventory activity ratio. Same idea, accounts receivables, but about the inventory. Now the question is, how many times we're selling the inventory during the year? How are we going to get? First, we're going to get the inventory turnover, which is cost of goods sold. We're going to get the cost of goods sold from the income statement. And we're going to divide it by the average inventory, which will be the beginning of the year, plus the ending of the year divided by 2. And then we're going to use that number as a denominator to get the date to sales inventory. As a numerator, we're going to use the number of days of the year. Again, this number is going to tell us how fast we're selling our inventory. So if the inventory turnover is 365, which will become our denominator, and as denominator we have the number of the day 365, that means every day we're selling our inventory, which is great for us. If I'm in the bakery business and if I'm selling my bread every single day, that's great. I don't have any bread left for tomorrow. So tomorrow I have to make more bread. But if my inventory turnover start getting low, and if I'm in the bakery industry, I may be in trouble with my inventory. I may even have to throw out my inventory. So let's see how this company performs. In 2019, the inventory turnover was 7.3. 2026 and 2021 dropped down below 5. What that means? That means we're not selling our inventory. First, we sell every 50 days, we're selling inventory. Then becomes 60 days. Now, currently, we're under 70, almost 75 days. So it takes to sell our inventory 25 additional days compared to 2019, which is a lot. I hope this is not a flour business or bakery business or anything related to food. Let's see, accounts payable turnover, same idea, accounts receivables, but for the accounts payable. Now the question is here, how fast we paying our credit purchases? We're going to get accounts payable turnover first, which is credit purchases divided by average accounts payable, which we're going to get beginning of the year plus the end of the year divided by 2. And we're going to use that number as a denominator to calculate how many days take us to pay our accounts payable. In this company, they started with 8.9 and dropped down to 6.5. What that means? That means that they're slowing down on payments. Before, take them 41 days to pay their credit sales. Now take them 15 more days or 2 more weeks. They delaying their payments with 2 weeks compared to 2019. I know coronavirus would happen, but still, that's a lot. 2 weeks in business, that's a lot. Those are the, again, those are the activity ratios. Those are the ratios that I'm going to test you on the quiz on May 7th. Accounts receivable, inventory turnover, and accounts payable turnover. You have to know how to calculate those 3 ratios, what that means, how to interpret the numbers. What is good for you, what's not good for you. That's where you have to be. Solvency ratio. Solvency ratio, again, is going to give us a idea. Is this company has ability to pay its obligation in the long term? Those are the indicators of the company level of the risk. Here we're going to have a leverage ratio. Leverage ratio will be simply debt to equity and net debt as a percentage of the total capitalization. We're going to talk about capitalization in a second using the Excel spreadsheet so you can understand it. And the next one will be the interest coverage ratio. Let's go with the solvency ratio. Solvency ratio will be debt to equity. Simply will be how much is the net debt versus shareholders' equity. That will be measured. Again, those one will be not tested in the quiz, but we're gonna explain it anyway, because you might need some of those for the assignment that you have to do in class. Measures the amount of the debt of the company, first one, relatively to the shareholders' equity. The net percentage of the debt compared to the total capitalization will be measured the total portion of financial financing which come from the debt. So before we continue, let's go quickly to the Excel spreadsheet and try to interpret those numbers and try to think about those numbers in terms of the accounting and what we already know about accounting. So those are the common size financial statement analysis. And we're going to leave it here, and I'm going to open a new worksheet. And in this worksheet, I'm going to go as high as possible in order to show you something. So everything starts. You have to remember this, and you have to understand it. Please spend a little bit time, understand this concept. That's going to help you for the rest of your life. I can guarantee you this. Everything starts with the very, very basic accounting equation, which is asset equal to, let's leave some space here, equal to liability plus equity. Everything starts with this calculation. Your life starts with this calculation. So, assets also represent your capital. If you don't have a capital, if you don't have the assets, you won't be able to generate revenue. You won't be able to generate expenses, anything. From where that capital is going to come? As we can see from the equation, you don't have that many options here. Seems like you have a lot of options, but you don't. Either it's going to come from debt, either it's going to come from investment. Those are the two options that you have. Debt is called liability, investment is called equity. And that's what you have. Now, under each of those, you have a different components. For example, under the assets, we're going to have the current assets, and then we're going to have long-term assets, as we saw last time. On the debt, you're also going to have a current liability, and you're going to have the long-term liability. And the equity section, we're going to have contributed capital, and we're going to have retained earnings, which comes from the net income. But that's pretty much what it is. That's how difficult accounting is. So under the capital, you have two types of capital, current assets and long-term assets. For the sustainability of the company, you need long-term assets. With the current operation of the company, you need those two. That's why from those two, current assets and current liability, we're going to get the current ratio, which is going to show us how liquid we are. Do we have a liquid capital to cover our current debt? On the long-term assets, we saw last time about the capital, which help us to generate revenue over the long period of time, usually over the life of the long-term assets that we have, based on their useful life. Now we come to the point, let's copy this one. We come to the point that, again, capital or asset is equal to debt and investment. That will be plus here. Now the biggest question is, how the capital, what's the structure of our capital? When somebody asks you what's your structure of your capital, simply he asks you, I see what's on one side of the equation, what's on the other side of the equation. What's on one side of the equation? The capital, since it's only one element here, it's always 100%. Now the question is, what's on the other side of the equation? If I know this is my 100%, what do I have on the other side? Now you can have so many combinations here, but at the end of the day, those two is going to be equal to 100%. So let's say the debt is zero. Well, how much will be equity then? It has to be this one minus this one. It has to be 100%. There's no magic here. We already know that those three work together. On one side, you have capital, which is 100%. On the other side, you have debt plus investment. So now what's going to happen if if I start borrowing money, if my debt to go to 20%, my investment's going to drop down to 80. Because on the other side of the equation, I have 100%. Now we're coming to the point. What's your debt to equity structure? Some people, they may say, okay, my capital structure is 2 to 3. Oops, that's not what I'm looking for. Let's say 2 to 3. That's my capital structure, 2 to 3. What that means to me means that debt, if we have to translate it, here, see, if I have to translate it, my debt is 2, my investment is 3, and my capital is how much? Can you quickly tell me? It's 5. That's what I have on the other side of the equation. I cannot make the numbers. They're already made for me. I just have to set whatever it is. So now can I express it as a percentage? Absolutely. How much will be 5 divided by 5? Well, that will be 100%. Then what will be 2 divided by 5? It's going to be 40%. How much is the 3 divided by 5? Well, there's not much options here. It has to be 60%. Make sense? Now, how much is the debt as a percentage of the investment or the equity here? Debt to equity ratio is going to be 2 divided by 3. Make sense? And once you see the number of the debt, what's the number of the equity? Remaining 200. Is it possible? Think about it. Is it possible the debt to be more than 100%? How? Okay, when you say yes, how? How it's possible? On one side, they have 100%. I have equal here. It has to be equal. You say that you're telling me that here I can have 120%? What will be the equity in that case? What will be the equity in that case? It has to be negative 20%. If my equity is negative 20%, what that means? I'm generating losses. Can I keep my equity minus 20%? No. So what do I have to do? Once this happens, I have to put those 20% from my pocket to increase the equity. If I do that, how much is going to be, in that case, my debt? If my equity moved down to zero again because I put in my money, how much will be now the debt? It's going to go down to 100%. Make sense? Do you understand this? It's a simple formula, people. On one side you have 100, on the other side you have two things. You have debt and you have the equity. That's how simple it is. So let's go back to our slides. And let's continue with the slides. So debt to equity ratio, again, is the net debt divided by shareholders' equity. And the net debt divided by shareholders' equity plus the net debt, which is shareholders' equity plus the net debt, will be actually your 100%, is going to give you what's the percentage of the debt out of the total capitalization, which we already saw it's the entire capital. So let's think about here. This company in 2019, the debt to equity was 0.42. So the debt was 0.42. Can you tell me how much was the equity? Right away. Having in mind that this one plus the equity should give you 1. If the debt is 0.42, how much is the equity now? Should be 1 minus 0.42, correct? Next one will be, now the next year, as you can see, now they start borrowing. The debt start climbing. And the third year, the debt get a little bit less. Is that good for the company? It's very early to say. We have to see more ratios. Now let's go with the net debt. How much is the debt out of the total capitalization? Out of the total net debt as a percentage of the total capitalization, it was 30%, 39%, 37%, which is the shareholders' equity plus the net debt in this case. Entire shareholders' equity. So now, let's go with another ratio, which is interest coverage ratio. Interest coverage ratio is very important ratio and always has to be looked together with the debt ratio. So, what that simply tells you? This simply tells you that how many times you have, how many times you can pay the interest expenses with the earnings before interest, taxes, depreciation, and amortization. That's EBITDA. It's income before interest, taxes, depreciation, and amortization. So this shows you, is this company has ability to cover the interest expenses. So let's see how this company goes. In the beginning, with the net income before interest, taxes, depreciation, amortization, they were able to pay the interest 13 times. Now, with the new debt, when they increase the debt to 37%, from 30 to 37%, the net debt or the debt to equity ratio become 59, they were paying with their income before interest, depreciation, and amortization, their interest expenses, 15.7 times. So what that means? That simply means that this company getting cheap debt. They have something better than they. The other company is they generating revenue, which revenue transfer to the income, which income they can pay their interest expenses. So increasing the debt for this company is not a problem. Maybe later, but not now. Next set of ratios are profitability ratio. Profitability ratio simply tells you how profitable the company is. We have a gross margin, as you saw on the income statement. That's the first checkup point, gross margin. How much we can generate from if we are manufacturing or merchandising company or even service company from our direct sales. Then we're going to have a profit margin, then we're going to return on equity and return on assets. Let's go with the gross margin. Gross margin is simple. It's a gross margin divided by sales revenue. Profit margin will be net income divided by sales revenue. Or in other words, as I said before, it's going to measure for every dollar of sales, how much stays in your pockets. So for this company, the gross margin from 20 increased to 22% almost. The profit margin fluctuate. We saw on the financial statements from 5.6 went down to 3.9 and then climb up to 4.4. Interesting thing, right? The gross margin going up, but that doesn't transfer to the profit margin. What that means? That means that we have in the middle between the gross margin and the profit margin, we have something that increasing, not in the same proportion like the other. What will be that? That will be operating expenses. So now we have to look back and see which of the operating expenses actually increasing and deteriorating that net profit or margin ratio. Profitability ratio on the return on equity will be net income divided by average total shareholders equity. How are we going to get that average total shareholders equity? Again, simple average beginning plus the end divided by 2. A return on assets will be again net income will be our nominator. Denominator will be simple average of the average total assets. Beginning plus the end divided by 2. So let's see for this company. This company, the return on equity first was 14 point, almost 15% and dropped down to below 10%. So what's happened here? The investors are losing the ability to earn based on the investment that they're making on the equities. On the profitability ratio, return on assets, on the return on assets ratio, from 8 point almost 5%, we dropped down to 4 point, a little bit above 4.5%, so 4% decrease. So whatever we're doing with the assets, we're not generating enough income here. Partially maybe because of the interest that we pay, more interest that we pay. Now, here we're gonna have earnings per share. Earnings per share, I'm not gonna spend too much time here for the explanation, but of the earnings per share, we should know that is that the net income minus the dividend that we have to pay for the preferred shares divided by the weighted average number of common shares outstanding. This is not simple average, it's the weighted average. So basically based on the proportion of the year, how much that weight out of the entire year. And that's how we're getting it. I'm not going to spend time, I'm not going to ask you to know this calculation. So for this company, and then we're going to have another one, diluted earnings per share. Diluted earnings per share, that's a hypothetical number, means that what's going to happen if the entire amount of the options which can be converted to common shares are actually exercised. That's a whole new 2 chapters here. If you want to go and learn more about accounting, then you're gonna see how those two are calculated. Again, we're not gonna spend time here. What we can see for this company, earnings per share slightly increases from 1.46 basic went to 153. Diluted earnings per share, the only thing that you have to remember, it always will be less than the basic earnings per share. Why will be that? Because denominator increase. If the denominator increasing, the number is going to go down. Equity analysis ratio will be the price market per share versus the earnings per share. That simply tells you how the market responds to the actual value of the company. So for this company, the price earning share ratio was 23.5 and it climbed to 24.7, which is positive here for this company. Equity analysis ratio is the dividend payout. What's the amount of the dividend per share based on the divided by the earnings per share? So in other words, if the company earns, as we saw, one per every common shares 1.53, how much of those 153 are given back to the shareholders? Obviously, it's not going to be 100%. So in this case, as you can see, earnings per share, they're generating earnings 153, but they're giving them only 70 cents per share. So in other words, they give them 45.8%. So what's happened with the other 83%? 83 cents per share, they keep it in the company as a retained earnings. Make sense? Dividends. On the dividends note, we can see that the dividends, that's another additional information to the financial statements, which is interesting for the investors. They to take a look and to compare how's the dividend, how much is the cash, how much is the which is dividend reinvestment plan for the company if they implement that reinvestment plan. Equity analysis, keep going with the equity analysis. That will be the dividend yield. That will be the dividend per share divided by price per share. Which price per share? That will be the market price per share. So basically, that's going to tell you how the payment of the dividend reflect the market price and what's the dividend yield in this case. So for every dividend that you now, if you have to purchase the share, you have to pay on the market 37.79. But you're going to get only 70 cents for every dollar. So you're getting 1.85%. That's the dividend yield for this company. Equity, the net free cash flow will be the cash flow from the operating activities. That's from the cash flow statement analysis minus the net capital expenditure. So how much we planning to expend, or we already spent or expended, minus the dividend on the preferred shares, if they're preferred shares, and whatever left, that will be the net free cash, which is available to the owners of the company. Now, those analyses are very interesting. You can get a lot of information. The question is how you're going to interpret those information. The other thing is, what do you know about the company? And what do you know about the industry? Also, there's a limitations. Those ratios can be manipulated. How that's going to happen? Through the accounting policy. Every company has their own, can follow their own accounting policy. They can be different from one company to another company, and that's going to give you different ratios. Definitions of the ratios. You have to know about the definition of the ratio, how the ratios are calculated. Otherwise, you're not going to understand the ratios, and you may make wrong decisions. Diversity of the operations. How diversified the company is means how affected the company will be on the small changes in the economy. Seasonality will be another thing. Is it a seasonal business? Is it not seasonal? And obviously potential manipulation from the management manipulation from the owners of the company or from the simply from the management of the company. Now, what else we have to look if we have to do financial analysis, and what I want you to see is the free cash flow. Is the company has a cash? Because simply the company may issue shares just because they don't have cash. Earnings before interest, taxes, depreciation, and amortization is another thing that I want you to look for. Net debt. How much is the total debt? Debt to equity ratio. Net debt as a percentage of the interest coverage. And net free cash. Those are the measures that I want you to look if you have to evaluate company which doesn't use international financial reporting standard. Means company which is not public company or a private company or private corporation in Canada, if you have to do this in Canada. So for those non-international financial reporting standards, when the company doesn't use those one, be very careful. Make sure you understand what kind of business they are first, how they're using, what kind of accounting principles, and how they're applying the standards, accounting standards, and the definitions in the company, how they recognize the revenue, how they recognize the sales. Sales and revenue, that's the same actually. And you need in order to do the proper comparison, you need more than 3 years. The other thing that you have to consider is most likely if you're comparing private companies, those statements are not going to be audited. Yes, they're going to be reviewed, but a light review from the practitioner, which is a compilation, not audit. And that's with our financial statement analysis. Very, very organized and very, very straightforward chapter.